So next, we want to dig deeper into the ETF market with specific topics around investment strategy, industry outlook, and portfolio implementation. And for more on that, please welcome to the stage Bloomberg News editor Yakob Peterseil.
Good morning, everyone. Welcome to our second panel of the day. My name is Yakob Peterseil. I'm an editor at Bloomberg News. I sit on our cross-asset team in London. We write a lot about ETFs, and there's a fairly simple and intuitive reason for that. It's because the industry has been growing by something like 20% a year for the past decade, to the point where it now holds over $5 trillion globally. It's made a lot of issuers, index providers, and perhaps even investors very happy, but it's also given ammo to critics who say that some of this growth may have come too far too fast. They're asking questions like, have ETFs actually made markets more fragile? Have ETFs been tested by something like a sell-off in high-yield bonds or bank loans, for example? So today, with our panel, I'm hoping we can hit some very practical questions about using ETFs, but also touch on some of these big picture concerns, like whether ETFs have actually increased the level of systemic risk. And I think we've got a great lineup today to help us do that. So without further ado, to my right, Andrew Jamieson from Citi, where he is global head of ETF product. Andrew oversees the various ETF specialists within Citi, everything from product origination to trading. So welcome, Andrew. And to his right, we've got Slawomir Rzeszotko, who is head of institutional sales and trading for Europe at Jane Street. Slav has the distinction of having worked on the biggest ETF trade ever done, so perhaps we can hear about that a bit later. To his right, we've got Deborah Yang. Deborah is head of indexes for EMEA at MSCI. She's been with the firm for 17 years and actually worked on the first emerging market ETF in 2002. Is that right? Yeah. Okay. Welcome, Deborah. And finally, all the way on the right, we've got Thomas Merz, who is head of European distribution from Vanguard, our sponsor, where he oversees the firm's ETF strategy for Europe. So welcome, Thomas. So why don't we dive in? Slav, I wanted to start with you. So, you know, I'm an active manager. I'm a stock picker. I'm paid to beat an index, not necessarily match it. Tell me why I should be using ETFs as an active manager, and if you can manage to convince me to do so, how do I use these in my day-to-day work of portfolio management?
Good morning, first of all. It's a question that we do get a lot, and to some extent I'm actually surprised that this question still comes up, particularly when I do look at the spectrum of clients that trade ETFs with us. And particularly that I think I would be hard pushed to actually find a passive manager that trades ETFs with us. So most of the clients and most of the flows that we're seeing are actually from a variety of clients, but they all have a goal of trying to generate the best possible return. And they're using ETFs in different ways, but to that end goal and that end objective. And most of them actually, when we look at where the trades that we do end up, are running some sort of active strategies. I think there's a growing understanding about how ETFs can fit into asset allocation, how you can use them tactically. Last year, we have commissioned a global ETF trading survey. One of the questions that we asked more than 200 clients institutionally was, why are they trading ETFs? And it was a broad range of responses as well. So the most popular answer was for tactical purposes, which obviously makes sense because you've got the liquidity, you've got access to liquidity. But then the second most popular answer, with more than 20% of respondents pointing out that they use ETFs for core asset allocation. And that is something that I think is closer to the heart of our sponsor from Vanguard today. But it also, I think, it's a great evidence of how much the fees managed to come down, making ETFs now a competitive tool also for allocators, not only for day traders or tactical investors. And that's a combination of management fees being now much more competitive and a combination of ETFs being more efficient from a trading perspective. So the cost of implementation came down alongside the cost of actually holding the ETF position. So I think those are the reasons why, that really isn't the reason why you shouldn't be using ETFs, if I may say so.
Got it. So you're saying you're dealing all the time with active managers who are actively using these so-called passive instruments.
Absolutely.
Yeah, okay. And Thomas, I wanted to ask you, because you're also you're facing people like asset managers, family offices. Are they puzzled about why they should be using ETFs, or how do you convince them that these are the right instruments for them?
I think, I can just add what we just heard from Slav, that ETFs have become kind of the preferred implementation tool. So, my clients or our clients actually view them as kind of the delivery mechanism of an ever-growing range of exposures. And I think I would like to point out, which was kind of clear from the equity exposures. So buying, kind of 500 stocks on the US equity and wrap them in an ETF, yeah, that's one thing. And you might be, experience quite a nice trading that basket in once. But where ETFs probably have made the difference is definitely on the fixed income side. Okay. It has, it used to be a very cumbersome exercise to make sure you get your exposure the right way, the way you want to have it in your active asset allocation. These ETFs now coming to the market and experience quite a smooth kind of trading experience, I think adds to the kind of convenience play. And that's how we have a lot of conversation across Europe with clients, whether new ETF clients or ETF clients who used to use the equity exposure through ETFs, they're now adapting that much more to other asset classes, in particular for fixed income. I think that gives you the answer. I think ETFs have, first of all, became a very smooth trading instrument regardless the exposure. And secondly, as we just heard, I think their prices have come down almost to a level where they're, the best instrument in town, right? That's the easiest way to get exposure. I think that is one definitely reason why ETFs took off so much.
Got it, yeah. And Andrew, actually, when we spoke earlier, you had kind of an interesting phrase. You said that ETFs are a technological innovation over the mutual fund, which was a really, I thought, an interesting way of putting it. Can you explain what
Sure, yeah, absolutely. I mean, I think one of the big challenges that we have is the continued misunderstanding and misconceptions around ETFs. People still think of these as something unique and different. In fact, even just in listening to Thomas and Slav, it's like ETFs, this is something new, it's different, but at the end of the day, it really just is a different technology of doing what people have always done. People have invested in equities, people have invested in bonds, and that's what an ETF does. And I think if I could possibly try and give you the most simple analogy that I could, if you think that the investment management community is merely trying to communicate to the end investor a series of investment ideas, that's not too dissimilar to the way the music industry is trying to sell tunes to the end consumer. And while the music industry has gone through various iterations, we've seen vinyl, we've seen cassettes, we've seen CDs, we've seen streaming, and in the investment management industry, we're still struggling to get out of vinyl, okay? I mean, the mutual fund is vinyl. It's 80 years old, it's an old technology, and we haven't really evolved yet. And ETFs really are like CDs. They are newer, they're probably more robust, cheaper, more user-friendly, and that's really the only difference. And I mean, who listens to music on cassettes anymore, apart from my father? Bless him. Everybody has moved on, and I think that's really where, we're going to see the mutual fund industry evolve, and why you're seeing so many new players come into market, particularly in Europe, who are launching ETF strategies. All they're really doing is future-proofing their business. They're saying, what we're doing today, we're just going to do it in a new vehicle as opposed to traditional mutual funds. So I think really that's a simple way to think about this. It's nothing too exotic. It's nothing that's not unsustainable. It's just a translation of how the industry has been and kind of dragging it into the 21st century.
Yeah. So I'm reminded of the fact that I still, for example, buy vinyl records.
Okay.
And a lot of people don't want to be dragged into the, particularly, for example, in Europe, where there's a huge mutual fund culture of fees and active management. Do you guys face resistance? And Thomas, I'm also curious to hear from you. Vanguard is coming into Europe. How much resistance do you face from managers who are saying, well, you're stepping on our toes now?
I think I want to pick up on what you just said before. In Europe, we have a mutual fund culture. And I kind of said, what the culture, what do you mean by that? I would argue it's actually something Sean also pointed out in his speech, is traditionally in Europe, and that's different to the US, traditionally in Europe, and still as we speak now, there was a distribution, or is a distribution model, which heavily relied on some kickbacks, on some incentivation for those entities who control distribution in Europe, still do, right? In some jurisdictions less than others, but they were and there are incentivized to, kind of distribute a certain type of investment, and that used to be is the mutual fund wrapper, which I think is one reason why there's still such a strong culture, as you named, a culture of using mutual funds, right? But I would also agree that, ETFs are nothing different than a mutual fund. They are actually a mutual fund, just traded, and the delivery mechanism is just differently. So hence, I think as soon or as long as this kind of incentivation structure doesn't change, the ETF still has kind of some room to catch up, right? I think what we see at the moment, that's what we're seeing changing, right? We're seeing changing through regulation, but also changing through the demand from clients. And obviously, and hopefully, Vanguard has a role to play to at least bring that to the surface and kind of explain, hey, you have an option via a mutual fund, but you also have an option through an ETF, and there's pros and cons to both, right? I think that's important. That's our role, which we would like to play. But I would argue it's not just a cultural thing, it's actually a market structure thing. And I see, in particular, this structure now breaking up more and more and more.
So you don't feel like you're necessarily, you've got some tailwinds, such as market structure and regulation at your back, right, what the industry does. This is not necessarily, you're fighting a losing battle here, right?
No, we're not fighting a battle, but we have a strong view that we think end investors should be educated on what they're paying for, what kind of services. And we have a strong view that our investors, or European investors as a total group, should be informed, where are hidden costs, where are explicit costs, and what the total kind of amount, how much it sums up to gain exposure to European equity, to Japanese equity, whatever you have there, right? Yeah. So I think our role is to have that conversation, engagement with clients, be it on the intermediated side, so working together with distributors, but also vis-a-vis end clients who should have this information in front before they make a decision, right?
Yeah. And actually, Deborah, I wanted to turn to you as the sole index provider on our panel. So we had, there was an interesting Bloomberg piece a while ago that pointed out the statistic that I think there are now more indexes than individual stocks. So instead of buying individual companies, people are increasingly buying groups of them, whether weighted by market cap or smart beta or some other weighting. What has that boom in indexes done to markets, in your opinion? And how has that changed the picture for investors?
I think generally our view is that choice for investors is a good thing. And of course, the way that MSCI looks at developed markets, emerging markets, you can slice and dice the market by sectors and styles, is really reflective of the overall interests of clients and their needs. Of course, if you have too much proliferation, that creates confusion. So it's important for MSCI to try to create frameworks so that countries are defined in similar ways, so there are no gaps and overlaps in how you build your model portfolios, to reflect the asset allocation decisions and so forth. So building out the frameworks are extremely important to us. And we work with the entire ecosystem. If you take a step back from where ETFs are, you go to where benchmarks are selected by big pension funds, sovereign wealth funds. Those are the managers of the assets that hire asset managers. And you have to beat these benchmarks, then I think it's really important to understand that we try to set some standards so that the proliferation isn't too great and the confusion isn't too wide. And of course, as mentioned, active managers are really complementary to the ETF user to reflect their decisions, to implement active decisions because of the benchmark that they have to follow and beat. They have to execute to that benchmark and then outperform and express their views in the subsegments that we slice and dice the market.
Got it. And of course, indexes, as we talked about, have given investors access to things they could have never bought before, right? I mean, you think of the single country ETFs, like there's a Colombia ETF, a Philippines ETF.
Yes.
That, of course, has made, as you said, markets in some ways more efficient because there's more sort of price discovery going on via these ETFs. Is that right?
That's right.
Yeah.
That's right. You now have access to these markets. You can capture different innovation. You can capture factor investing, which is really the staple of active management for years, where you can capture quality, value, or size, et cetera, and capture it all into one index and capture it through a wrapper of an ETF or passive fund. And by having these tools, you can now express yourself in your investment logic of, well, maybe I'm underweight value at this time, or my portfolio doesn't have enough size exposure, and now you can tilt your portfolio that way. So that innovation has been quite an exciting one. I would say with the over 10 years ago, with smart beta proliferating into the market, there was clearly a lot of confusion that was happening in the marketplace, and we felt there was a need to have an industry standard on factor definition. That's just one example. So MSCI created factor classification, which is the GICS of factors, so that innovation can also be a simplicity of message. So simplifying the factor knowledge and message and be able to communicate to wider audiences beyond institutional investors, but also wealth and retail. That's an example of innovation.
Yeah.
I think if I may add, I think that element, and maybe you will touch upon it later in the conversation, that there's a lot of talk sometimes because ETFs are growing so fast about dangers and threats that they pose. But I think the element that is being often overlooked is the benefits that they bring. And I think one of the most striking benefit is how democratic ETFs make the investment process. I mean, you're looking really at a suite of products that are available at largely the same price to individual investor, retail investor, as well as to a huge sovereign wealth fund and a pension fund. And that's uncommon, to say the least, in the investment world. And then you're also looking at a situation where you can build yourself a portfolio, often with disastrous results, as myself looking at my private savings, right? But like, you can do that, of course, doing as granular allocation as a professional, including fixed income, and bringing fixed income into the listed environment where you actually have an over-the-counter asset class trading in intraday listed environment. So I think that is something that should not be overlooked in any of those conversations about threats of ETFs.
Yeah, and when you say democratizing the investment process, I mean, I'm thinking even of like, you know, the private equity ETFs, hedge fund ETFs, you know, the so-called alternatives. Is that an area that you see also growing in Europe? I mean, it's a bit nascent in the U.S., but Slav or Thomas, have you seen activity?
If I may, but please add. That's where I'm not so sure whether this industry or this subsegment of this industry goes a real promising path, because I think we heard it already a bit in the discussion, and I share some concerns there where we kind of neglect the basic of ETFs, and when it comes to those asset classes, I think the basic of ETFs is the ETF is first foremost as liquid as the underlying, And if you suggest, kind of more liquidity than there is, just because it's wrapped nicely in an ETF and it's kind of, says ETF on the tin, that's where I also kind of have some reservations. I think we better off as an industry also to do plain talk and really explain, the details of this instrument. Because we don't want to, find ourselves in the situation to explain that an illiquid asset class, or is not as liquid as expected. Because it is illiquid, and the underlyings do not trade as liquid as equity and in some more liquid bond parts. So I'm, personally stand. Yes, obviously. Gain access to more niche exposures can have an advantage. However, there are some physics rules about liquidity and also being not too narrow to kind of lose out on the broad diversification benefits of passive investing or passive implementation should not be violated in my view.
Yeah. And so how do you avoid that? Do you stick to things like very liquid underlying assets like equities?
Yeah, we at Vanguard definitely do. Okay. We have a strong view on that investing should be straightforward, simple, well-balanced, well-diversified, at low cost, and should be also kind of a very liquid investment. Okay. Just that nobody gets confused about what that instrument does. So I think we kept ourselves quite to a limited number of we think relevant exposures, which give good and perfect access to those important risk sources which you might want to have in the portfolio, but kind of avoid to do kind of the very exotic niche and fancy dancy puppet kind of exposures, which we don't believe doesn't bear any investment merit.
Okay, yeah. And so where does that leave things like high yield bond ETFs or, God forbid, leveraged loan ETFs? Do you guys agree that you should stick to sort of, as Vanguard does, to the more ultra liquid sort of underlyings, or is there room for a bit more niche exposure in ETFs?
Can I just make one point? I mean, I think it's important here just to clarify again some of the misconceptions around ETFs. It's allowing you to invest in things that you couldn't otherwise do. Now, that may be correct at a singular level, in so much as, to the example in the Philippines, you may not, as an individual investor, buy a portfolio of underlying Philippine securities, but you've always been able to invest in a Philippine mutual fund, which has existed for a long time. Okay. So an ETF is much the same. And, clearly, as Thomas is saying, the Vanguard philosophy is perhaps to stick to more vanilla type exposures, and that is very suitable for some type of investors. But again, in Europe today, perhaps as much as 80 to 90% of the AUM is held in sophisticated institutional hands. So I think at the end of the day, if they have the risk appetite to invest in different types of opportunities, whether it be private equity or high yield bonds, then ETF serves a purpose and a vehicle to do so. And I think it's again one of these misconceptions that somehow ETFs are an irresponsible way of investing, whereas it's just a modern technology to do what has always been available to the sophisticated investor.
Yeah, and do you feel that ETFs have been adequately tested by something like a bout of volatility or a sell-off?
Well, if you read in the press, one of the great, again, myths out there that ETFs, of course, have never been through a crisis, they've never been tested, and as Sean mentioned earlier, ETFs are celebrating their 25th anniversary. That's when SPY came out, and even in Europe, you're looking at least over a dozen years since things like ISF came out. And in that time, we've had Lehman, we've had subprime, we've had flash crash, we've had peripheral Greek, we've had Brexit. It's very topical at this moment. So, we've been through a lot of market shock and uncertainty, and these products have been very robust, and they've done what they said they do on the tin. And to date, we haven't had any structural issues around ETFs. So I would kind of challenge back and say to the people who are saying this continually, well, of course, ETFs have never been tested. Clearly they have.
Yeah. So, I mean, in the broader ETP space, for example, in February, when the VIX spiked, we had a couple of, I guess you'd have to call them blow-ups in certain volatility products.
We had a blow-up in VIX, okay? Right. Again, let's be clear. It wasn't a blow-up in ETFs. It was a blow-up in VIX. And it impacted, naturally, a vehicle that gives you exposure to the product that had the blow up. So if you have a blow up in the Philippines, it will affect Philippine mutual funds, Philippine ETFs, Philippine single securities. There is no difference. There is no added detriment in terms of the ETF or ETP wrapper in itself.
Got it, okay. So you still feel a sophisticated institutional investor, as you say, many in Europe are, know what they're getting into. If they buy a VIX ETP and are comfortable with that, then it should be fine, right?
Well, again, I'm not here to give investment advice and to recommend whether people buy or don't buy VIX products. But if your question is specifically around, did the ETF reflect what the VIX market did, I would say yes.
Okay, fair enough.
There is clearly something to I guess, what your question was pointing out at, that the ease of access to general public can actually mean that a very sophisticated ETF will end up in an unsophisticated pair of hands. And I think there's what Thomas was saying earlier, I think there's a shared responsibility in the industry as it's growing, starting from index providers when they design the indices, then going on through all the sort of participants of the ecosystem, if you like to use this overused word, in making sure that the proliferation of products stays responsible. So, you know, from a market-making perspective, we would probably want to have a conversation with an issuer who comes to us with a product idea where we think that the underlying asset class is not lending itself easily to provide two-way markets in a listed environment. I'm sure from an issuer perspective, Vanguard look at it from a very detailed investment-focused approach. So there's a lot of people that need to do their work properly to ensure that this rapid growth of the new technology of wrapping up investment strategies does not end up in such a way that we are like CDs and we are going to be obsolete if Andrew insists that we are at a CD status.
And again, look, I mean, it's no different. If an individual security has a blow up, people don't suddenly say, well, we shouldn't invest in stocks anymore. So in the same sense, if you think of ETFs as a technology and not all ETFs are the same, then I think it's the same premise, really.
So it's a vehicle, right?
Absolutely.
Not an asset class, yeah.
And I think some of the innovation that you want to look at different asset classes, you first want to start when you construct an index, what is the underlying data that you have? And if the data is improving, more transparent, and if it's material and interesting. I mean, one example is the ESG space where there's huge improvements on data quality, and now we can create indexes on ESG, which enable innovative solutions to be captured traditionally in the active space and now being able to put onto passive and ETF. So I think the first thing to look at is data quality and whether or not that's stable, and then determine whether or not there's an index that's logical, and then whether or not the wrapper. I think that's the general way of looking at the market.
And I think just to add to this discussion, I think it becomes pretty clear that some fear, which probably in the beginning of the development was, ooh, I'm an active manager and I'm not going to be used in 10 years' time, comes pretty clear, right? These are sophisticated discussions, and the ETF is a delivery mechanism which just gives me access, but that due diligence, that thought process will be here, in my view, you know, all the time. And that's why ETFs more and more become actually a tool for active manager. But at the beginning of that process, right, I remember, you know, starting 2000, 2003 in Europe, that was like the fear, or, you know, they're going to grab my business and I'm going out of business. No, that's not true. It's just another tool in the toolbox. And the real thought process, probably today still very heavily human-driven. Don't know how advice will evolve over time, but that's the core bits of construction of portfolio. And ETFs is just a tool in that toolbox, which probably very efficiently give me access to some most liquid exposures.
Can I make one, I think, hopefully an important point as well, that in terms of how the business has evolved over the last couple of years, you know, we're talking mainly here now as if this is a buy and hold product, but really the evolution of this is it's replacing a lot of derivatives, whether it be futures, CDS, CDX, and therefore is a much more liquid product that is turning over very regularly. And I think, again, one of the great misconceptions is when people look at the activity that replicates what people would traditionally do in futures and other derivatives, they think that ETF investors are skittish, that they don't hold, that they basically sell very quickly in volatile markets, but that's absolutely not the case. This is, again, something that is being used to fulfill a certain purpose, that is the flexibility and the adaptability of this technology that makes it different from the traditional mutual fund. So please don't be concerned when you see turnover on ETFs and think, well, that means that people are going to head for the exits whenever there's volatile markets. It's because people are using them for a different purpose.
Yeah. Speaking of intraday liquidity, I mean, Thomas, John Bogle has famously sort of been critical of intraday liquidity. He thinks people should buy something and hold it for decades. I mean, how do you square that at Vanguard with the ability of people to trade in and out of ETFs? Not necessarily that they are doing this on a daily basis, but do you see that as a good quality?
I think, goes to the answer we just heard. Different investors have different strategies. But yes, they're using ETF, which we just, now for that discussion, just put everything in one bucket, but it's not, right? Some are using it for equitizing cash because they're, they haven't made up their mind how they're going to invest, maybe single stocks, or they give it away to a third-party asset managers, and they just want to not have it sit, particularly in our environment where negative yields or at least zero, right? So they want to equitize that bulk of money, and why not doing it the most easy way through an ETF and just, it's exposed to a certain asset class. Others do it more technically. A third group would do it via factor exposure. A fourth group, which is more probably retail, right? And that's where probably John Bogle's mindset sits, right? End investors constructing a very balanced, boring portfolio with 2 ETFs, right? Yeah, of course. Why? That's clear. Buy and hold and rebalance, right? But here comes rebalance as well, because that's one thing which Vanguard definitely believes in. You should have a strategic asset allocation, but stick to that strategic asset, which needs, you need to rebalance your portfolio. So I think it's too simple to say ETFs are not good because they create turnover. If they do, for investors who should have a buy and hold, rebalance portfolio, yes, we also agree, but there are other uses of ETFs which they have done via other instruments, other means, and they're using it because it's so efficient. It actually makes their outcome, their portfolio outcome, even better by using this instrument. So we're absolutely behind that. We think that's meaningful, right?
On that note, I think we've hit our time, so thank you all very much. I hope you got as much out of that as we did, and a big round of applause for our panelists. Thank you.